Learning objective 9.4, we're going to describe other long-term liabilities. Most public companies maintain two sets of accounting records, one for financial reporting and one for tax reporting. Having two sets of records is a legal requirement. It's not cooking the books, it's what's required. Two different sets of records result in timing differences between the financial reporting set and the tax reporting set. These timing differences can result in a liability, deferred income taxes. Under normal circumstances, if you were to follow GAAP for tax purposes, if you were to follow generally accepted accounting principles, you may owe quite a bit in taxes. But because there are some tax strategies that are allowed, that are legally allowed, you may not end up owing as much as what you might have thought of based upon the GAAP income. However, because taxes technically, in most cases, are not eliminated, they can be deferred into the future. So you still owe the money, you just don't owe it in this year. You're not going to have to pay it this year. You're going to have to pay it at some point in time in the future. You don't even know when, because it really kind of depends on what your tax situation is in the future. But you show it as a deferred income tax liability because you know at some point in time it's going to have to be paid. So the first thing we look at is income tax expense, and we're going to compute income tax expense based upon the income that is derived from GAAP income. So whatever your net income is, let's just pretend that you're going to pay taxes on that net income. So that will be what you recognize as income tax expense for that period. What is actually owed when you complete the tax return and compute the tax liability, you have what is called income tax payable. Now that's computed by taking the tax return and looking at, based upon whatever strategy you used on the tax return, how much do you owe the Internal Revenue Service, or even the state. In California, it would be the FTB, Franchise Tax Board. So the amount that you're going to show on a balance sheet of income tax payable represents the amount of income tax a company will pay to the federal and state, you should add, and state government at the end of that period, or what's due at the end of that period, what you're going to actually pay. So for most companies, income tax expense, you would think that income tax expense, whatever you book as an expense, is going to also be equal to what the liability is. In a perfect world, that would be the case. But the fact of the matter is that's not usually the case, because companies are always looking for strategies to defer income tax into the future. I know the perception is that all these corporations get away from paying taxes, and there are credits out there that actually do allow for that. But the majority of strategies used by corporations is deferral. You're pushing it off to the future. In fact, you do that as well. People do that through their 401ks. They do that through their traditional IRA accounts. They defer income tax into the future so that they don't have to worry about paying it now, and it's just a common strategy. So let's take a look about how this would be computed. So Southwest's pre-tax accounting income, $2,500,000,000, and its income tax rate is 40%. So if my accounting income is $2,500,000,000 and my income tax rate is 40%, then my expense is going to be pretty easy to compute. You're simply going to take $2,500,000,000 and multiply it by 40%. Now this is going to be as of December 31st, and so we'll go ahead and do that. We're going to take income tax expense, $2,500,000,000 multiplied by 0.4, that's the 40%, and that means that we have $1 billion of expense. So therefore, our income tax payable is 1 billion. So if we're going to be looking at how this would be presented on a financial statement, you would see that you have income before income tax of 2,500,000,000. We computed income tax to be expense to be 1 billion. So your net income on an income statement will be listed as 1,500,000,000. And you will also show on the GAAP financial statements $1 billion of liabilities. This concept of deferred income tax is just for narrative purposes, for you to understand it and know that it exists. But the reality is we don't really cover deferred income taxes until you get to intermediate accounting. And most of you won't even plan on doing that unless you are an accounting major. So that's something to look forward to. Oh my goodness. Let's go to commitments. In terms of long-term liabilities, what do we mean by commitments? A commitment is a contractual promise to make transactions in the future that create financial obligations for a company. Companies are obligated to disclose to shareholders and creditors in the footnotes to financial statements. So when we talk about a contractual promise, it's just a promise for the future. It's not something that you owe right now, but you have a commitment to owe it in the future. Here, that's kind of funny. Let's say you sign a lease for, let's say, a 5-year term. So leases allow businesses to use an asset without having to purchase it upfront. And finance leases enable the company leasing the asset to own it after a period of time. Operating leases allow the company leasing the asset to use it, but not eventually own it. So it's kind of funny how we use the term leases. You would think leases is simply just rent. But a lease can be strictly rent, which is operating leases. That's just renting something. And then a lease can also be something that will eventually be purchased at some point in time in the future. May be purchased. Not necessarily, not completely committed to purchase, but potentially. So something that is relatively new, a new FASB standard for leases. This goes into effect for public companies in December 2018 and non-public companies in 2019. It requires finance and operating leases longer than 12 months to be capitalized and put on the balance sheet, which is quite interesting. But even though you're not technically required to pay it, the new FASB provision says you have to put it on the balance sheet and show it as a capitalized lease and a liability. So this may significantly increase long-term debt and total assets. It's going to be a balance, and you're going to increase your assets for that amount, whatever that is, and increase the liabilities. But in doing so, you can distort or change, I should say, the debt ratio, because you're going to have more debt to finance the existing assets. And so now your debt ratio is going to increase, and also there's going to be a decrease in the return on assets.